Your trucking coaching business is booming. Your trucking business is booming. You're bringing in $200, just say, and $50,000 a year of profit, which then in limited liability companies, the profit flows all the way up through the owners, all the way to the individual. Add it up, right? We had $1 million of taxable income, right? We had $1 million. So I'm gonna bring it to another page. So we're talking about, I love seeing all the zeros. So we had $1 million of revenue, but now our consulting business, having this consulting LLC, which did our marketing for us, we then took $100,000 of losses, and now we're at $900,000 of taxable income. So instead of paying Uncle Sam, theoretically, 30%, right? So, or $300,000 in taxes, you're now paying Uncle Sam $270,000 in taxes, right? Times 30%, which has now saved you how much? $30,000 of taxable liability or taxable expenses you would have paid. So now we start using our tax strategist and your business coach who set you up the right way to now say, you know what? We can write off the personable, tangible property of all of this real estate, meaning anything that we can take off with a screwdriver or a hammer out of these buildings, we can write off. The stairs, the doorway, the window panes, the ceiling fans, right? The cabinets, we can write all this stuff off. The toilets. So now we start adding up the 100% deductions that we can take from this real estate. So we find out of our apartment building, by the time we wrote off everything, we could write off $200,000 of expenses from our apartment building. And then we found out from our flips, and maybe some of these are long-term holds or whatever it is, there was an opportunity to write off, we'll call it $20,000 for each flip. So now we have $260,000 of losses that will offset this gain. So now we have $200,000 gain, but now we're looking at a $260,000 loss, which means we now are negative $60,000. So now there was no profits made off the real estate from a taxable standpoint, although there were profits made, but you were able to offset that taxable income by claiming your proper losses because you had great tax strategy. So now you're going to roll this $60,000 of profit up, and so now we're going to wash that 200 and that 60. So now instead of 9, we got 7. God bless you. So we got $640,000 now of taxable income, right? That flowed up now to this business. So if we did that times now 30%, right, of taxable income, 213, what's that, 18? 190,000, right? 192,000? 192. Yep. I got this. $192,000, right, of taxable income. So we have to pay $192,000 in taxes. But remember, we were at $1 million before our tax strategy and business coaching kicked in. So we were at $300,000 of taxes. So now we look at our taxable savings. We have $108,000 of money that would have been spent and sent to Uncle Sam and just out your pocket, and you're just like, hey man, I made good money this year. I still made $600,000, $700,000, but I spent $3, and it is what it is, and it is what it is. But now you got to keep $108,000 in your pocket just by a little bit of strategy. It's setting up your business and your corporate veil in a proper way. That 108 can now be reinvested into other investment opportunities, other businesses, go to your children, to your legacy, commodities. Go treat yourself to that car you wanted. I mean, you're going to throw it away anyway. So that's the opportunity from having the proper tax mitigation strategy. And this is just kind of one strategy amongst many, but it's where real estate really comes in handy in this current tax climate.